This
years.
conference will
I've
now
been
be recorded.
so I've been so while my experience is into a different domain, right, from relationship management to the branch banking. I was heading a branch. I've introduced a branch, large branch in a private bank, then to NRI banking, and now into a forex. So I have a well diversified experience across the retail branch banking, across customer due diligence, KYC, uh, audit, branch management. So this is my brief profile. Today's topic is to give you an insight and a highlight about why KYC is required and what is customer due diligence, why banks across the globes are very, very particular about their customer onboarding and everything. So, so all these exercise, definitely there is a law behind this. In India, we call it as a Prevention of Money Laundering Act, which has been enacted. RBI is definitely giving a directions to a bank to strengthen their financial system so that they cannot be used by money launderers to park their illicit funds. So, to start with, I would like to first give a brief introduction on this money laundering cycle. So, there are basically three stages where a criminal can launder their money, and there are three stages we call a placement, layering, and then integration. So, placement is basically nothing but placing of a cash or other asset derived from a criminal activity into a financial system. So, it is basically a blending of funds. So it's a commingling of illegitimate funds with the legitimate funds, such as placing the cash from the illegal narcotic sales into a cash-intensive, locally owned restaurant business. So by commingling, they just simply go and place the funds. This is the first step. Second step is to, because at the end of the day, so there are other steps also, like if somebody has a illegal cash, they break up the amounts, placing a cash in a small amount and depositing them into a numerous bank accounts in an attempt to evade reporting requirements. Loan repayment is another, paying a loan by acquiring uh, legitimate loan using laundered cash. Then the stage comes to layering, where they try to move the funds quickly, maybe electronically, so that so the second stage is basically to separate the separation of illicit proceeds from their source by layering of financial transaction intended to conceal the origin of the proceeds. So basically, it is a concealment of the origin, and finally, they wanted to do a lot of layering. They move money from one bank to other bank account, from one financial institution to other, or within the accounts at the same institution. So this is called layering, so that they can just create a sense of legitimacy around the transaction. And third is technical integration, where they use the money to buy assets like a property or maybe artwork, jewelry, or a high-end automobile. So technically, by using all these illicit funds, uh, money launderers generally do all the activities, and it generally harms a country. There is an economic and social consequences of a money laundering to any country or any financial institution. Hence, every financial institution try to prevent themselves being used as a channel where money launderers can easily park their funds and rotate their funds. So technically, if I I go a little deeper, there are a lot of risk associated, and hence there are a lot of rules and regulations. First, there is an increased exposure to organized crime and corruption. Uh, so whenever any country is perceived as a haven for the criminals, so or maybe there is a limited type of institution and a person covered by money laundering laws and regulations, or maybe a little or no enforcement of the laws and a weak penalties or provisions that makes it difficult to confiscate or freeze assets related to money laundering, or maybe a limited regulatory capacity to effectively monitor. So that becomes a kind of a heaven for these kind of criminals. Sometimes these type of activities also undermine the private sectors, because you see the ultimate. So what they do, money launderers, they generally use front company businesses that appear legitimate and engage in legitimate business, but are actually facts controlled by criminals. So they commingle their proceeds with the front end companies, and hence then they start selling services or the products at the below market prices. This makes it difficult for the legitimate business to compete, and hence they distort the overall environment. This increases the potential of monetary and economic instability, and hence every government, every institution tries to stop it. Finally, there are other things which also they do. There is a reputation risk for the company also. So a reputation as a money laundering or a terrorist financing haven can harm development of economic growth in a country. Uh, uh, so people will refrain themselves in putting their money. So there are a lot of financial flows in terms of FDIs. Generally, economic or developing countries they seek actually. But when an investor see a country as a heaven of a money launderers, sometimes for them it is very difficult because they need to have extra scrutiny in working with the institution in the money laundering havens. So the cost is very high. So they generally avoid. Plus, there is a risk of sanction also those countries. So if a country is weak on KYC or maybe a client onboarding process or overall tracking of the money laundering, uh, so there is a possibility that they might be subject to sanctions, which will again will lead to a difficult position. Like so, OFAC is a designated. Uh, I'll give an example. In order to protect the financial system from money laundering and terrorist financing, the US, UN, and the European Union and other governing bodies may impose sanctions against foreign countries. And once they put a sanctions, they generally try to uh, uh, they also put a sanction to those countries who are weak and who generally do the business with the designated sanctioned countries. So hence, this is the background why this is important. Now, I would like to take you through the Indian law. This is the so. Can you take the slide to number 3? Yeah. So it's the Indian law. So with this background, every country is obligated to have strict laws and regulations so that they can prevent their financial institution to being used by these criminals. So in India, we have PMLA. PMLA 2002 was enacted and came into effect in 2005. This is called Prevention of Money Laundering Act. So this is a law which has been passed, and we can go to the second. So basically, this law criminalizes the money laundering and provides for freezing and confiscation of assets concerned in money laundering. So this law gives the power to the authorities to freeze and confiscate the assets. Also, uh, under this law, banks and financial institutions have an obligation to maintain records of the transactions. So there is obligation towards the banks also. They have to follow this. Also, there is a obligation under this law that all the financial institutions, in case they suspect any transaction, they have to report it to Financial Intelligence Unit of India for further understanding and getting the depth of those transactions to understand whether it's a money laundering case or not. So basically, the objective of the this law is to prevent, control, and combat the activities concerning the money laundering. So we can go to the next page. So this is basically features. So basically under this act there is a rigorous punishments, and so there's a 3 years rigorous imprisonment, which may extend up to 10 years. There is a record keeping obligation. I just in my previous slide, all financial institutions, including banks and NBFCs, intermediary, they have to maintain the records. Otherwise, they are subject to heavy penalties. And also, there is a special court provision in case they need to be prosecuted if they can be constituted to try to money laundering offense. So there is a special court provision also. Plus, there is a reciprocal arrangement with other foreign countries in case there is a case where it is known that there is a money laundering, and so attachment seizures even with the foreign countries. There is a provision they can transfer the accused person also. So these are major features of this Prevention of Money Laundering Act in India we have. And the background I already told you that why it is required, because it has a very serious consequences, and it can lead to a dampening effect on the overall country economy and the development. So we can go to the next page. So basically, banks and financial institutions are the gatekeepers. So if anybody wish to park its illicit funds, they have to open a bank account. So to open a bank account, they have to use a financial institution. RBI is a regulator in India who regulates the financial institutions. So RBI is instructed, and he has given guidelines that there is a comprehensive guideline issued to the management of the commercial bank to follow the compliance, and guidelines also as a safeguard for the banks from being used unwittingly used for the transfer or deposit of illicit funds for financing of terrorism. So there are a lot of guidelines which RBI gives, or there is a so so banks are obligated in India to follow those PMLA Act and the RBI initiatives and the guidelines. In absence of that, they are subject to huge penalties. And so this is an initiative by PMLA. RBI is a regulator who regulates the Indian banking system and gives direction to the CEO of all the commercial banks to apply a proper anti-money laundering program or a compliance program within the bank to avoid bank being used by the money launderers to place the funds. So we can go to the next slide. So basically, what there's a broad coverage of instructions uh, generally RBI gives, and within those instructions, individual financial institutions can also have their own guidelines. So basically, the broad coverage of instruction includes you should know your customer. So there is a KYC document requirement for both new and existing clients. So customer, so generally you identify a person by his identifiable documents which are issued by a government authorities. So he should have a proper identity. He should have address proof. So you should have a proper KYC while onboarding a client, even for the existing client. Depending on the risk of that particular individual or account, KYC needs to be revisited again and again. While onboarding, so for the existing customer, there's a CTR monitoring, cash transaction report monitoring. So once we onboard a client to a bank, depending on the profile of a client, we monitor a transaction. And in case if there is any deviation, there is a CTR reporting which generally happens in the bank that it is not matching the profile of a client. So there is a CTR, cash transaction reporting monitoring is an obligation which bank has to do to prevent this institution. There are risk management tools and internal controls like audits. Generally, in a bank, we have internal audits where internal auditors generally check whether the onboarding process, KYC, everything has been taken care of or not. Then there is a suspicious transaction reporting process also, where if a front end staff identify that there is a transaction which is suspicious in nature and client is not able to give a valid justification for the transaction, then they need to report it. This is also an obligation for a bank. Also, adherence of the FCRA Act is also an obligation for an institution uh, uh, where there is a foreign currency involved. So FCRA accounts are basically for the trust. So generally, trusts are made, and there is a foreign currency contribution coming from the various other institutions. So there is a specific purpose for which these funds are received. So they are generally foreign contribution, foreign funds which are received in India, and these FCR accounts are being opened for a specific purpose. So this purpose and use of the fund is being strictly monitored. So this is also an obligation so that they cannot be used otherwise. So let's say fund, the purpose of FCR account is to have a social development or maybe education in a tribal belt. But when the funds are coming and they are being withdrawn for other purpose, which might affect the overall fabric of a country, then that is a problem. So adherence of FCRA Act is also very important, which the banks are obligated to follow that. There is a record keeping which is there in case there is a requirement and somebody wish to go back and look the transactions, and so that is also required. Front end staff and other related staff, there is an obligation of a bank that they should train their staff and management towards AML and KYC requirement, identifying the client and onboarding of a client, because they are the gatekeepers within the banking system. So overview of reporting under PMLA is basically, so there are certain transactions, each and every transaction needs to be reported. So there are certain thresholds which bank follows in India. So all the cash transactions which are greater than 10 lakh needs to be reported. Cash transaction, uh, all the series of cash transaction integrally connected, like 7 lakh plus 3 lakh or 5 plus 5. So they're integrally connected. They've just split it. So they also needs to be reported. Sometimes people avoid. They generally do a transaction below a threshold, and maybe they can give a gap of 1 day, 2 day. But then if they're integrally connected, that needs to be reported. Uh, Counterfeit currencies. So these also needs to be reported in case there is a heavy cash transaction and there is a regular feature. Even so, whatever counterfeit currency, even a single currency note, that needs to be reported. So this is an obligation as per the PMLA. All the STRs, suspicious transaction reporting, whatever transaction, whether it is done in a cash or whether it's a online transfer, whether it's a check transaction, if customer is not able to give you a valid reason or the source of fund for that transaction, that needs to be reported as a suspicious transaction, or that if that profile is not matching the transaction, uh, customer is uncomfortable if a bank staff start asking or probing, then it leads to a suspicion that needs to be reported, irrespective whether that is a cash or non-cash. So we can go to the next page. So technically, banking companies are under obligation to follow all these banking and non-banking financial institutions. So these are all the banks, cooperative banks, and all the chit fund companies, insurance companies, NABARD, hire purchase companies. All these companies are under obligations uh, to follow this KYC, PMLA. Even the intermediary like stockbrokers, share transfer agent, trustee, portfolio managers, they are all under the purview of this law. So this is uh, so this the law has a reach to all these institutions, all the financial, non-financial institutions. They have to follow. They have to, uh, as per the guidelines, they have to have a record keeping. They have to monitor. They have to report. Uh, as a part of onboarding, they have to follow proper KYC. So everything they have to follow. So we can go to the next page. So I was talking of STR. So STR is nothing. So STR is what? Any transaction which is giving suspicion that it may involve a proceed of crime. So that is called STR. Or maybe it appears to maintain circumstances of unusual or unjustified complexity, no economic rational or any bona fide purpose. Like a customer having a small restaurant in a small city, getting a multiple cash deposit from across the city, nearby cities, though his business line is only of that particular city, within that a small shop, a small bakery shop, getting a multiple remittances, multiple cash deposit, where there is no business interest or there is no business reach. So it creates a suspicion. A student account technically receiving a lot of foreign remittances, which has no justification actually. So these type of transactions generally leads to a suspicion, and that leads to a reporting. Broad categories like producing a false ID, account opened with the name of very close to other established business entity. So there is a, let's say there is a big business entity and another company also try to open the account with the same business entity name. That gives us suspicion. Why? And also if there is a background or a link with the known criminals, then also that also leads to a suspicion. Uh, Large number of accounts having common account holders. This is something which is very common. So 5, 10 accounts with a common holder. So technically, one does not need beyond 1 or 2 accounts. So if somebody observe that there are 10, 15 accounts, 20 accounts, having a common account holder who's controlling the account, that also leads to suspicion why it is required. Unexplained transfer between multiple accounts with no rationale. So a housewife getting a transfer from unknown or unrelated parties, and further it is going to some other account, which has no rationale because she does not have any income. Just like so a small accounts or a student account, I just give an example. So unusual activity. Account was dormant since 5 years, 10 years, and there is a certain activity in the dormant account. That also gives us suspicion. frequent purchase of TD with a cash under the threshold reporting. So the cash has been utilized to purchase a financial instrument which can further be used as a layering. Transaction not in line with the business activity. So e-commerce company depositing a lot of cash. Or cash, uh, a cash business, cash intensive business, we can understand it's a petrol pump who has a cash, a retail business or a restaurant. But any other business which has no cash component and is still depositing a lot of cash and is saying it's a proceeds from a business like a consulting company which has no retail setup, which has no purchase of goods or maybe a trading of goods. So that also leads to a suspicion. Remittance received from unrelated parties. So that is also leads to a suspicion. So there is no business linkages. There is no relationship established. However, still there is a movement of funds and cash deposit not in line with the turnover. A small shop depositing a lot of cash. Not if a bank official goes and do a contact point verification, field verification, he finds a small shop having a very less business, but they are doing a lot of cash transactions. So that also leads to a suspicion. Abnormal customer behavior. So whenever you start asking or probing the source of fund and they generally start avoiding you or they so that also leads to suspicion. So these are the indicators, broad indicators where a bank official generally understands, okay, there is a suspicion and depending on further probe and further site visits, field visits, they generally try to understand whether actually it is a STR or not. So we can go to a next page. So there is an obligation now today topic we are talking about Prevention of Money Laundering Act. So there is an obligation for the financial institution to report these transactions. So cash transaction, every institution has to report 15th day of the succeeding month, basically. So if in the month of November, if some CTR happened, so next month by 15th they have to report it. So there's a specific format which bank follows. Every bank has its own formats which they follow, but they report 15th day of the succeeding month of happening of the transaction. Counterfeit currency within 7 working days from the detection or the occurrence of the transaction, they have to report it. STR also, whether or not made in cash, they have to report within 7 working days. So transaction information required to be preserved, which I was sharing that, okay, we have to, bank have to, or financial institution have to maintain a record of transaction. There is obligation. So they have to maintain the nature of transaction, what amount exchanged, date of transaction, the party involved in the transaction. So these type of information they generally preserve under the PMLA. So we can go to a next page. So as per the Master Circular of RBI, KYC of a bank should have 3-4 pillars. That okay, these should be the basic checks they should do. They should have a customer acceptance policy, customer identification policy in place, monitoring of transaction, and risk management. So basically, these are 4 pillars around which the KYC or the an anti-money laundering program has been, or a compliance program is generally set. We can go to the next page and I can explain each and every. So customer identification process involves there can be this is a process which can be carried out in different stages, like establishing a banking relationship. While establishing a banking relationship, you have to identify a client by a set of documents, like a identity document, like a passport in India, a PAN card, maybe Aadhaar card, uh, address proof, maybe electricity bill or local landline bill. While you customer identification process is not, they does not stop at the time of onboarding a client. So when you onboard a client, when he start doing a financial transaction, also you have to monitor his transaction. So while monitoring, also the identification is a process which generally goes on actually. Also, when a bank has a doubt of previously obtained customer identification data is incorrect, that he has furnished the wrong proofs, wrong information identity, then also, so it's a continuous process identification of a client, whether it's onboarding or maybe an old client which is already a bank customer. So transaction monitoring is basically frontline staff has a major responsibility. So they identify a client while onboarding or while doing a transaction or daily monitoring. So they act as a trigger point, and also their electronic database which supports them like a large transaction reports, event-based triggers. So large transaction reports and event-based trigger. Event-based trigger is basically nothing but any trigger or any transaction which is not as per the customer transaction behavior. So let's say there is a customer who's a salary customer. There is a salary. There is a one credit as a salary, and there are a lot of debits. But then, if you see other than salary, there are other debits are also there are other large credits are coming in the account. So it's unusual. Or a customer who has a general trend of a salary, suddenly a 1 crore check deposited in the account. So it's a uneven. So it's a trigger. So it's an unusual activity in the account. So when this happens, the backend system triggers that it's a event based trigger. It's an unusual activity. Go and monitor and try and understand the transaction. And if suspicion, please report. So there are alert systems, there are software. So there are a lot of transaction monitoring at the back end, which generally bank does, and it's an obligation as per the PMLA. We can go to the next page. So basically, again, the risk management is basically it's an obligation again. Record and report containing the information, retention of record, appointment of a principal officer who oversees the overall program of a bank of a compliance. So this is obligation, and technically this all is required to mitigate a lot of risk of a financial institution. So there is a goodwill risk, there is a reputation. So goodwill risk, what happens if a customer loses a confidence in a bank? So generally, what happens? They start withdrawing the funds. They start withdrawing. They will not place a funds which it's a great risk. So we have seen in the past a lot of financial institutions they have even closed down because there was a goodwill risk because of operational risk. Sometimes operational risk can also lead to a goodwill risk because if there is a weak operational system, we have seen an example of operational risk in case of a PNB Bank where Nirav Modi has taken a loan and then because of the bias credit, because of LOU, so there's a operational oversight. Bank has given 11,000 crores of loan which they could not able to recover. So that was an oversight or the lacuna in the operational risk, which has led to a reputational risk also. We have also seen a concentration risk. Concentration risk means a bank or a financial institution has assets or a book size concentrated towards one client only. We have seen in PNC Bank recently in Mumbai, where their asset size, whatever they've borrowed, whatever from the retail side, all the depositors, they have lent to only one institution, HDIL, Housing Development and Infrastructure Limited. So the total loan book size of that institution was 8,880 crores. 73% of that loan book size, they have given it to only one corporate, which is defaulted. So again, so these type of risk mitigants, a bank has to ensure that they should not get into a trap. And this all leads to a legal risk because a lot of lawsuits are filed against the bank and which are also very heavy in terms of the uh, overall fees or overall expenses they have to make to mitigate all those things. So banks are working towards goodwill risk, operational risk. They need to manage this, and they can only manage this by having a proper compliance program in place. So these are the four pillars which generally banks work around. We can go to the next page. So once we onboard account, as per the obligation, as per the onboarding process, we need to understand what is the purpose of account opening. So why he's opening an account? What is the requirement of this account opening? A housewife opening a multiple account. What is the use of this account? She doesn't have any income, or a under guardian opening account without any specific reason, or so. And what is the source of fund? So once the account is opened, what would be the activity in the account? What is the age of that individual? That age and the source of fund and the purpose of account that commensurate. What is the employment detail and identification of beneficial owner? sometimes these chartered accountants and maybe some financial intermediaries, they open account, they become a front face, and we don't know about the beneficial owner of that particular account. So that we need to unwind and find who is the ultimate beneficial owner of that particular account. What is the customer occupation? What are his financial statements? Whether he's opening an account in the catchment area or not. This is again something which a lot of banks are following nowadays. They don't open an account other than their own catchment area, because every 5 kilometers the banks are available of the same. Uh, so if a bank has a branch in one area within the 5 kilometers, they have 2 3 more branches. So if a customer is coming out of 20 kilometers, specifically opening an account on that particular branch, that needs to be probed. So catchment area is something which has become very, very important. What is his nature of business? What is his anticipated turnover? And in case there is a change in activity of the account, the transaction, what is the explanation? So these type of client profiling generally a bank does to mitigate the risk which might lead to a laundering of the funds in their accounts. So these are basic profiling generally front end staff does. And based on the initial profiling, the triggers are set, monitorings are set, and in case there is any deviation, uh, generally they are being monitored and they've been asked and they've been probed by if there is a deviation in the profile. So this is just to satisfy initial satisfaction. This is a major component of a client profiling that one does while onboarding a client. We can go to the next page. So the fonts are very small, but basic documents are required to ascertain KYC, resident individual ID proof, PAN card, Aadhaar card, passport card as ID proof, address proof, anything Aadhaar, voter ID, signature proof, PAN card will do. So they're so legitimate documents. So these are the basic documents which are required for the account opening. Non-individual account, there are various different accounts bank open. So if it's a private limited company, there is a certificate of incorporation, there is a board resolution, copy of PAN of a company, copy of a telephone bill of a company, KYC of a directors. They're required. If it's a partnership form, we need to have a registration certificate, partnership deed, KYC of a partner, telephone bill, landline, trust. There is again trust deed, PAN card. So basic there is a listed documents, KYC documents, which generally bank don't deviate, and this is a part of our onboarding process and part of KYC. So any deviation on this requires a management approval, and generally uh, banks avoid so that at the time of onboarding they are 100% satisfied that whatever customers they are allowing to enter into the banking system is legitimate. We can go to the next page. We can go to the next page. No, we can go to the next page. I think it's done. So these are basic documents which are required as a part of KYC.
Yeah, I will go to the next page.
The bank don't deviate. Yeah. So basically, so there are possible red flags uh, which arise to a suspicion that why. So there are few things which one can note. While account opening, a customer is unwilling to provide the required KYC or not giving enough details or not allowing you to profile him by just saying that, okay, by exhibiting unusual concerns for secrecy. So that gives a trigger that why he's doing that. Customer request for a standard document waiver. So generally, uh, so why he's asking for a waiver? Customer has very difficulty in describing his own business or the purpose of account opening or expected transaction in the account. So he's not aware of that. Customer is not residing in the catchment area. Again, this leads to a suspicion. A lack of knowledge of its own industry. So let's say a customer is opening an account of a restaurant and he's not aware of the nitty-gritties of the business. Defensive stance on questioning. So when you start probing him, so he become or she become defensive. There are multiple businesses happening on a shared address. So that also leads to a suspicion that why it's happening. It's a shell company, whether actually business is happening or not. That leads to a red flag of possible money laundering. as a front end staff, as a front end managers. So these are the part of training where we've been trained to identify and to trigger and to report. We can go to the next page. So possible money laundering flags as far as transactions are concerned. That customer is not concerned about the commissions and the transaction. He just wanted to get away with the transaction. He's not bothered whether it's costing him heavy or not. Plus, there is a transaction which involved a senior political figure uh, having a account opened in his relative's name, which has a source of funds moving without having a proper justification, uh, with no logical economic purpose. Multiple cash deposit in an ATM after and immediately withdrawal through ATM. Use of so a customer coming for a locker operations just before deposit of a large cash, he visits a locker and it gives a suspicion. Multiple safe deposit customers has is holding. Early repayment of a loan in a cash, prepayment or overpayment on a credit card, unwilling to provide documents to prove the shipment of goods and services. So, so a lot of triggers, lot of red flags. Generally, in a transaction we see, and according to the situation, we need to understand. Again, the profiling is very important for clients. Once you get into detailed profiling of a client, and if there is a deviation, definitely there is a risk. We can go to the next page. So I'll just go to other risk mitigants. CPV is one risk mitigant which generally bank officials follow. It's basically a profiling. Branch officials visit while onboarding a client. If it's a business, he visits the business premises, check all the details, whether actually business is happening or not, number of who are the employees, number of employees, fixtures, furniture, business activities seen or not. Generally, they report, and then finally customer is onboarded after giving a satisfactory report. So a risk containment unit of a bank generally randomly picks firms, and they also trigger a third party verification other than bank staff. So third party who is on hired, so they're third party, they will go and verify the site. They will do a site visit and submit the report, and if that is satisfactory, then only account is onboarded. So there is third party verification and reference check while we are lending. So while we are lending to a client, uh, so let's say there is a jeweler and he is asked for maybe a working capital loan or a term loan. And if a customer has a jewelers in their own portfolio, they generally do a cross check about the reputation of that particular jeweler. So it's a close referencing check also, apart from scanning the and making the credit appraisal memo of a client depending on the financials and everything. They also do a close ref check within the related parties. Trade KYC also is one thing which they closely monitor. No deviation is accepted. So these type of risk mitigants generally banks are used. So while we were discussing about the PMLA, how banks mitigate the risk, what is onboarding, this all activities is all exercise just to avoid banking system to be used for a money laundering purpose. And there's an obligation also. Uh, so that's all from my side, friends. In case anybody has any questions around this, I'm happy to answer.
Thanks, Akshay, for giving us such a insightful information and knowledge into, you know, our KYC and AML, Indian AML laws and regulations. So, guys, we are open to any Q&A sessions. If you have any queries, please feel free to ask. Akshay, I have a query. So, could you just tell us any tools name which Indian banks will use for client screening or for transaction monitoring?
So technically, I don't have the names handy. It's a separate
Okay.
department, but then it is generally done by the core backend system. So
Okay.
since I'm not involved directly with them, so I cannot comment on this. What are the softwares they use? What are the vendors they use generally to check about? World check is one I know they used to screen about the sanctions
Okay.
in case there is a sanction which if they are coming in a OFAC list or not. So there are various softwares which generally banks involved. I'm into not directly to that particular domain.
Okay.
So it will be very.
And
I don't want to give
as
a
I
vague.
see,
I don't want to give a vague answer on the number. What are
okay.
the vendors? What are the softwares they use? Because technically there are a lot of softwares and vendors available. But since I'm not directly involved in that, so I don't have that kind of understanding and the knowledge of those softwares.
Okay, no problem. So I have one more query in terms of AML and KYC regulation. As you know, you are handling the branches and you are leading other branches as well. So there might be situations, few customers would like to override few regulations or few threshold limits. So in such situations, how do you handle it and how do you mitigate the risk? Could you please throw some light on it?
So there are two type of scenarios. One is there is a new to bank customer whom we are onboarding and who's trying to evade or avoid certain KYC documents. And there is a we first understand if there is a legitimate reason behind the waiver of those documents. So I married women, a recently married couple, a woman uh, shifting to a husband's place does not have address proof, and so we understand the guardian does not have address proof, or a person shifted on a transfer to a new location does not have any address proof. So there are various scenarios where there's a legitimate reason that why he is not able to provide a proper KYC document, maybe most likely address proof. So that can be tackled by doing a site visit report, by doing a contact point verification, by doing a reference checks, or maybe by opening account into a debit freeze initially, and then maybe after the clearance of exception, we can regularize the account. So there are various scenarios which can be handled. As far as the already old account, existing bank account, and asking for certain deviations for
Mhm.
some transaction, like so those cases, KYC is already done. So bank is satisfied as well as their KYC is concerned. uh, it comes to a certain transaction which they wanted to get into an exception, which they wanted to get through an exception mode. Like so, it's a risk kind of a appetite of an individual or an individual or of a specific financial institution that what type of transaction they can entertain on a scan basis. Maybe originals can be collected later basis of the fax and email indemnity bank has, or what type of a controls. So that all depends on the client profile, risk appetite our institution has, and the system controls they have. So just like NRI account, if a
Mhm.
NR needs to open an account if he's overseas, it has to be non face to face. Customer cannot. Sometimes they are in India, they come to a branch, present physically, and show their IDs, and so one can verify. But what if they're overseas? So in that case, there is a non-face-to-face process which generally financial institutions set up, wherein they send the documents to a scan process, or maybe send documents by notarizing documents overseas by a bank, or maybe a notary, or maybe an Indian embassy. So, so these type of exceptions, these are exception transaction or onboarding of a client, uh, case-to-case basis, they can be taken up. So there is absolutely uh, so it's very flexible. So depending on the comfort, depending on the profile, relationship, conduct of our account over the period of time, uh, a bank or a financial institution, depending on their own risk appetite towards the client, they can take a call.
Okay, thank you so much. And team, if you have any other questions, you can unmute yourself and ask your query to the speaker, or else you can ping on in the group chat as well.
Hi Tiwari. Sorry. Hi everybody. Ravi here. Actually, my concern is that when we are analyzing the transactions monitoring, some of the transaction monitoring looks much suspicious even after user or client has provided the sufficient document for the as per our investigation requirement. But hence, when we are raising a UAR, means unusual activity report, or transaction suspicious transaction report, if we are raising to our concern team like this FIU team, how FIU team is interacting with the regulatory, I mean to say NCA. My client is like my regulatory is a NCA. So how they are interacting each other, and how many like is there any parameter to set out the like suspicious activity they are modifying, or they are directly closing the account? How it works in the background? I just want to know it.
So I think Hemant, you have to take this question. This is a core backend activity which uh, a compliance officer does while deciding to report the transaction to FIU. So basically, what happens once transaction is
Mhm.
reported as STR, it goes to a backend. Transaction is being analyzed. If that needs to be reported to FIU, compliance manager decides, and he records the reason whether it needs to be reported, or if even if it is not to be reported, there has to be a documented reason, which generally compliance manager gives. But as far as the other part is concerned, I think Hemant, you need to answer that.
Yeah, sure. So, Ravi, to answer your query, so they're like, once a potential activity is detected from the front end, because usually all the potential or red flag activities will be detected from the front office, like who are facing the client, like a teller or any other front office team. So once they detected any kind of red flag activity or suspicious activity, they will report it to the AML team or a compliance team, and then compliance team will review those transactions or documentation or whatever activity uh, the front office has escalated. And once they review it, and once they speak to the front office as well, and giving some kind of analysis and doing some kind of investigations, and they will take a decision whether to file a STR or not. Then it requires a lot of groundwork, investigations, and discussions between different stakeholders within the bank, because a lot many things involved in this taking a decision for one particular STR. So I hope I answer your query. So if you
Yeah,
have
Hemant, I understood it. But the concern is that when they are starting to work in the background level, there might be internal or external audit must be involved. And when they are found potential looks like continuous suspicious means going on the account. So, and we have like a certain period, like a month period to report. Means our complaints officer is ready to take the decision. Like we have to escalate this case to the regulatory, and if you are doing beyond the time frame, is like any kind of the penalty charged by regulatory
Yeah,
or not?
definitely. If a bank is refusing to file a suspicious activity or to report any kind of STRs, definitely you can see the news. RBI is penalizing banks, or payment. You can see the payment UPI payment services provided left and right. Recently, they have fined SBI, Punjab National Bank, 1 CR or something, due to their, AML failures, or not reporting, or not following any kind of, KYC regulations. So yes, they are. To answer your query, yes, they will fine. I mean, like, regulators will penalize the banks or financial institutions.
Okay, Hemant. Okay, Akshay. Thank you. Thanks for your
Yeah,
answers.
Yeah,
and to
yeah.
get more insight, yeah, please
Just
go
to
ahead.
add
Yeah.
on this, that's why there is a very strict guidelines on the local branches who are initiating the transactions, like a front customer facing retail bank branches. So if CTR has to be reported, it has to be reported 15th day of the succeeding month. If they delay reporting, even if they report on 16th, it's a default. And when the audit comes, they penalizes the branch. Like count of
But
it. See,
yeah,
so there is a
but
deadline.
sometimes,
So there is a
yeah,
so
but
there is a
when we,
deadline.
sorry, keep
Yeah.
continue.
So what I was trying to submit here that there is a specific deadline to report, and once it is reported, and once case is escalated at a compliance manager level also, there is a deadline whether, and he has to decide whether to report or not report. And for both the things, he has to document the reason. So he cannot sit indefinitely by not even the. So he has to take a decision within a certain time frame. Otherwise, there is a penalty which is being levied on a financial institution, which Hemant.
Exactly. Yeah, I
Yeah,
agree with your point, Akshay. Thank you. Thank you, Hemant.
Thanks, guys. So, as we are running out of time, thank you so much, Akshay, for giving such a great insights on Indian banking laws and going through us few red flags as well. Thank you so much once again, and thanks for the team
yeah.
participating and listening for this program. We will send you your participation certificates in 1 day or two. Thanks again, and have a nice weekend.
Yeah. Thanks everyone.
Thanks.
Yeah,
Okay, bye.
thank you.
Thanks, everybody.
Thank you, Akshay. Thank you, Hemant.
Yeah.
Be safe.